U.S. economy faces turbulent 2023 as recession fears grow. The U.S. economy will be in a precarious position by 2022. In an aggressive effort to combat inflation, the Federal Reserve has increased interest rates in an effort to slow down consumer demand. However, prices have remained stubbornly high, and by solving one issue, the U.S. central bank runs the danger of starting a second one, a recession. The Fed has raised interest rates at their quickest rate since the 1980s in response to persistent and high inflation, a move that might endanger the economy in 2023. According to a monthly survey of experts conducted by Bloomberg, the likelihood of a recession in 2023 increased to 70% in December, from 65% in November. 38 economists were questioned for the poll, which ran from December 12 to 16. Bill Adams, chief economist at Comerica Bank, said that the U.S. economy, if it is not already in one, will most certainly slip into a recession during the coming year. The federal funds rate is already firmly into restricted territory as a result of the Federal Reserve's approval of 7 consecutive interest rate increases this year, including 4 increases of 75 basis points. Policymakers hinted at their intention to hike rates again in 2023 and keep them there until 2024 during their most recent meeting. Additionally, officials predicted that as interest rates rise and the U.S. teeters on the precipice of a recession, economic growth would slow down significantly and unemployment will rise significantly, reaching a rate of 4.6% in 2013. By compelling businesses to reduce spending, rising interest rates tend to result in higher rates on consumer and commercial loans, which slows the economy. Joe Bruzuelas, chief economist at RSM, stated that the Federal Reserve set the predicate for an eventual pause in its efforts to restore price stability in early 2023, even as it indicated it intends to continue lifting rates into an economic slowdown. Although Fed Chair Jerome Powell has acknowledged the difficulty of avoiding a recession, he has also pushed back against the certainty of a downturn, suggesting that lower inflation prints in October and November could boost the odds of a soft landing, the sweet spot between curbing inflation without flatlining growth. To the extent we need to keep rates higher and keep them there for longer and inflation moves up higher and higher, I think that narrows the runway, Powell told reporters. But lower inflation readings, if they persist in time, could certainly make it more possible. I don't think anyone knows whether we're going to have a recession or not, and if we do, whether it's going to be a deep one or not. It's not knowable. But what could save the U.S. economy from a recession in 2023? Central banks around the world are determined to do whatever it takes to fight inflation, including pushing the world economy into recession. But a few things could diminish the chance for that to happen. The chorus of economic analysts, investment strategists, and think tanks calling for a global recession in 2023 is growing bigger and bigger. For example, in a report featured in Bloomberg News over the weekend, the Center for Economics and Business Research predicted that higher interest rates would likely push the world economy into a recession next year. The battle against inflation has yet to be won, said the report. We expect central bankers to stick to guns in 2023 despite the economic costs. The cost of bringing inflation down to more comfortable levels is a poorer growth outlook for several years to come. Central bankers' determination to fight inflation heightened last week when the Bank of Japan joined its peers by raising its benchmark rate, ending a prolonged period of near-free money. A global recession is bad news for both Main Street and Wall Street. For Main Street, a global recession means declining business revenues, failures, layoffs, and rising unemployment. For Wall Street, a global recession means a lower top and bottom line, which leads to lower valuations. Thus, steep declines were seen on Wall Street in recent months, as traders and investors usually anticipate rather than follow economic news. Still, a few things could save the world economy from a recession in 2003. One of them is an acceleration in the decline of inflation seen in recent months. It could be caused by the softening of aggregate demand and easing supply chain constraints. For instance, the softening of demand has left many retailers like Target, Costco, Nike, and Lululemon with excess inventories, which could lead to lower prices as these retailers cut prices to eliminate these inventories. In addition, a decline in home prices will ease pressure on housing costs, which account for 42.36% of the Consumer Price Index, CPI. Then there's the precipitous decline in the Baltic Dry Index, BDI, from 5,400 in October to 2021 to 1,500 recently. It could lower transportation costs, a critical component of the prices of goods. And there's the easing of oil prices, from $122 per barrel 6 months ago to $80 recently, easing the cost of energy, another critical component of the cost of living. An acceleration of the decline in inflation could force central banks to pause interest rate hikes sooner rather than later, thus averting the prospect of a full-blown world recession. Michael Ashley Schulman, the chief investment officer of Running Point Capital Advisors, sees a couple more scenarios that could avert a global recession. If China continues to stimulate and reopen its economy, global commodity demand should increase, and simultaneously, finished goods prices should decrease as supply chains normalize. He told International Business Times, "Some of China's recent moves to stabilize the real estate mess are reminiscent of the U.S. Troubled Asset Relief Program during the Great Financial Crisis of 2008-9 that stabilized the financial system in the U.S. Then there is the prospect of ending Russia's war against Ukraine. It has been an innumerable strain on all economies involved and incalculably inflationary. A peaceful resolution to the terrible conflict would decrease risks, lift stock markets, and make global financing cheaper," Schulman said. "It will end the European migrant crisis, lessen energy prices, and increase food security, results that could help mitigate recessionary fears." According to Peter Schwartz of Jive Consultants, the most crucial factor that could save the world economy from a recession in 2023 is to believe it's not a foregone conclusion, and therefore not make a recession a self-fulfilling prophecy. This is a similar concept to President Franklin Roosevelt's phrase during the Great Depression 80 years ago. "The only thing we have to fear is fear itself," he said. The Commerce Department's final reading Thursday morning showed gross domestic product, the broadest measure of the U.S. economy, grew at an annual pace of 3.2% between July and September. That was above the 2.9% estimate from a month ago. Economists surveyed by Refinitiv had expected GDP to stay unchanged from its previous reading. The report said the stronger-than-expected reading was due to increases in exports and consumer spending that were partly offset by a decrease in spending on new housing. Consumer spending is responsible for more than two-thirds of the nation's economic activity. U.S. stocks tumbled Thursday on fears that the stronger-than-expected GDP could prompt the Fed to continue to raise rates more than expected in 2023. Stocks ended the day off their lowest levels, but the Dow still lost nearly 350 points, or 1.1%, while the S&P 500 fell 1.5%, and the Nasdaq was down 2.2%. The data was stronger across the board, and if there's anything the Fed does not want to see these days, it's better than expected data, said Paul Hickey of Bespoke Investment Group. The Fed has been raising interest rates throughout the year to cool demand for goods and services and reduce inflation. Economists have been worried for quite some time that the Fed's actions could tip the U.S. economy into recession next year. "The reality of the Federal Reserve's determination is sinking in," said David Kotak, chairman and chief investment officer at Cumberland Advisors, referring to efforts to get the economy back on a path towards 2% inflation. "I don't see how a recession is avoidable unless the Federal Reserve changes its policy." The big market downturn Thursday could be aided by thin trading at the end of the year.